You're listening to the New Jersey Real Estate Investor Podcast. We talk about all topics related to being a real estate investor in the Garden State, based on our experiences with buying, selling, managing, and building rentals. So together, we can all be better investors. Now, here is your host, Pete Tverdov.
Hey guys, welcome back to another episode of the New Jersey Real Estate Investor Podcast. I'm your host, Pete Tverdov, and wanted to dive right into today's topic, which is going to be how to calculate if a buy and hold rental works. And I thought that would be a really good topic to talk about because I do get a lot of people who ask me that question, whether they are, mostly it's like new investors or potential clients. So this episode is for you guys. So I hope you study and listen to what I'm going to teach you because I feel like you're going to feel a lot more prepared once I finish with the podcast. And this is kind of a spin-off of one of our earlier episodes where we talked about how to buy your first rental property. So I suggest you listen to that one, maybe even first, because that'll give you an idea of like where you're even looking. And this episode's basically, okay, Pete, I know where to look now. Like, how do I know if this is a good deal or not? Like, people ask me that all the time, and it's a difficult question to ask because a lot of people have different ways of evaluating a property. Today, what we're going to talk about are two ways to calculate how buy and hold rental works. The first is appreciation, and then the second is cash flow. Okay, because those are mainly the two reasons why people get into real estate investing to begin with. They either care about the appreciation or they care about the cash flow. And if those of you listening, if you know anything about the stock market or stocks, right, you have stocks that are an appreciation play, right? So those are your Teslas, your Googles, your Apples, high growth companies. They don't necessarily pay a dividend. Then you have other stocks that are dividend paying stocks, so that you actually get money from that company every quarter, but the stock doesn't appreciate as much. So real estate investing is very similar to that, if that makes sense to you. So we're going to talk about appreciation first. So when someone comes up to me and they're like, yeah, I really just care mostly about the appreciation, there's a couple of things you have to research and know, okay? So the first thing I would say is, if you do care about appreciation, is you need to study that area. And you don't necessarily need to ask a realtor to do this, but you could go look online and look at sales the last few years, and just look at how the pricing has changed over the last few years. Like if you're looking in a townhouse community, or if you're looking at multifamily houses, just look on the maps on Realtor.com, on Zillow, places like that, and go back. I think you could go back like 3 years and try to figure out how the market has appreciated in that town. There might even be like blog articles about it. I know I've personally done that when I've explored looking into different markets. I've tried to see like what the appreciation has been. And I think that's important. And I don't think it's bad if there's been a ton of appreciation. Okay, because that means like it's a hot area, it's a desirable area where a lot of people are trying to invest in. That's not a bad thing. On the flip side, if you go back 5 years and there's no appreciation, especially now, that would kind of scare me, to be honest. Because then because remember, if you're buying it for appreciation and there has been zero, well, that ain't good, right? So that's something to look at with respect to appreciation. Another thing you want to focus on is job growth. And now that's very easy for me to say. That's very broad. So, okay, Pete, how do I figure out, what the job growth has been in Atlantic City? Okay, well, Google it. See like what companies in that city are building or investing in that area. Like, is there, are they building out hospital space? Is there a university in the area? Is there a pharmaceutical company? Netflix, guys, is opening up I think like a studio somewhere in New Jersey, right? Like that's job growth, right? So you want to try to study and see where there has been job growth in that particular area that you're focusing on. And again, I go back to why it's so important to know where the heck you're looking to invest, because I think you guys could realize that as I'm talking, right? Like if you don't know where to invest, You can't answer any of these questions if you don't at least have an idea of what area of the state you want to invest in. Another important one regarding appreciation is the housing stock. So you want to see, and sometimes the best way to do this, guys, is to drive around, like the city or that town or towns that you're looking in. How much new development has happened? Do you see a lot of construction going on? Are there a lot of apartment buildings going up? Now, why is that important? Because if they're building, and in every town they're usually building, you want to make sure they're not oversaturating the market with rentals, right? Because you're buying a rental property. I'll give you guys a quick example, and these are real facts. We are currently renting out another apartment in Elizabeth. Okay, it's overpriced, and we've told the owner that. But this is our management. I'm talking with our management company now. It's the rental's too high. I want you to think how many current rentals are for rent in Elizabeth right now. 1, 2, and 3 bedroom apartments. Think in your head. It's a big city. Okay, over 160 places are for rent in Elizabeth. That's a lot. That's insane, to be honest with you. So to me, that's like, wow, okay, there's probably a little too much housing stock in Elizabeth for rentals right now anyway. So you need absorption. So, that's potentially problematic in that area right now anyway, right? So that's why you want to look at housing stock. You want to see what's being built. That's why job growth is so important. What's attracting people to move to that area, okay? And then future development. So again, Google is your friend. Like Google, whatever town you're thinking of, right? Like let's say it's Westfield. Like Google Westfield zoning board approvals, or Google Scotch Plains zoning board approvals, or Lawrenceville zoning board approvals, and see what's been approved. Like, has there been big projects approved? For example, like in Perth Amboy, the word on the street is Jared Kushner got approved to build 600 units in Perth Amboy. That's pretty cool. That's going to be good for the area. God bless him for doing that. So how will that affect the appreciation of the area? Because the other thing is, if there's lots of building going on, that also usually raises the value of the property, because that means builders and developers are kind of looking in the area, and maybe they eventually want to buy the property that you own. Population growth is another one that's very important for appreciation. So how could you do that? Well, they do a census every 10 years, right? They've done one in 2020, 2010. They're going to do one in 2030. So, Google Fair Lawn, New Jersey, population growth. Union, New Jersey, population growth. Whatever town you're looking in, Google and see what the population growth has been. See what the trends have been. Because if you're looking for appreciation and the population growth is flat, or it's even shrinking, that also could be problematic for appreciation, because the market's not as hot or as strong, right? So I go back to a couple of the other points I made. So if there's a lot of, let's take the example with Elizabeth, right? There's a lot of rental stock, like I said, but what's the population growth been like the last 20 years? Is it strong? Okay, so then maybe there's an absorption rate that could handle all the new housing stock. Is there new job growth coming in? Are there new businesses investing in the area, right? So that's all tied in with population growth. But the easiest way to do that is looking at the census. Another one for appreciation, and this is an important one, inflation. You should want to know about what the inflation rate is. And why is that important, Pete? Well, because if inflation in the country is running hot, real estate is an inflation hedge, right? So, between 2020 and 2024, inflation was probably 30 to 40% across all products, including real estate. Okay, so if the inflation rate is high, that's good for appreciation, because you're going to be hedged. If the inflation rate is low, that's also not a bad thing, but maybe the property won't appreciate as rapidly. And guys, I got news for you. It's not normal for a house to appreciate 5, 10, 15% a year. That's That's not normal and that's not sustainable. But it's something that you need to pay attention to if you're investing and wanting to own a buy and hold rental for inflation, or excuse me, for appreciation. And then one of the last ones I was thinking about for appreciation, will your investment beat the stock market? And I have this conversation with a couple of people who I personally have tried to get them to buy an investment property. And unfortunately, I can't get them to see the forest through the trees. And that's okay. Because not everyone needs to invest in real estate, right? Not everybody invests in stocks and bonds and crypto and gold and businesses. But the simple argument is, well, Pete, I could take this $150,000 down payment you're telling me to make and just put it in the stock market. And, the stock market gives me 8% a year. And, and then if I want to sell it, I could sell it tomorrow. I could sell it in 10 minutes, which I get. But what you have to understand with that argument is if you're investing $150,000 in the stock market, right, and it goes up 10%, you made $15,000. If you invest $150,000 in real estate, there's this little thing called leverage, right? So you put $150,000 down payment and you probably have a mortgage of $500,000 on a $650,000 house. So if that $650,000 house goes up 10%, what's 10% of $650,000? $65,000, right? And this is like, the stock guys just can't wrap their head around that, right? There's leverage. So I understand you wanting to beat the average returns of the stock market. But I think the example I just described kind of annihilates that argument. So those are several things you need to think about if you're only investing for appreciation. If you don't care about cash flow and you're like, you know what, Pete, I'm a doctor, I'm a lawyer, I'm an investment banker, I'm a high-earning W-2 employee, and Uncle Sam is absolutely slaughtering me on taxes, which is true, by the way. And if you work in New York City, it's even worse. And if you live in Manhattan, forget it. You're like 60% of what you make goes to Uncle Sam, right? Those people need a tax write-off bad, right? And so I personally get some clients like that where they just need the tax write-off. Dude, find me a good market. I just care about appreciation. Okay, cool, no problem. So those are some things you guys need to think about if you're worried about appreciation. Now, for those of you who want cash flow, right? You care about cash flow. Pete, show me the money, baby. I need to make some money. Okay, I got you. So the people who care about cash flow, appreciation needs to like sit at the back of the bus, right? Because you care about cash flow. So these areas of the state are different. Like it's even the neighborhoods in certain towns and cities are different. Okay, so you need to understand that because there's not as much demand, and usually like high cash flowing areas, not usually, but sometimes it's more of like a tougher tenant class, I would say. So, but that's I touched on that with another podcast. So for cash flow, you're either going to do one of two things. You are going to get a mortgage on the property, or you're going to pay cash. Okay, and I'm going to help you calculate both. So if you're going to get a mortgage on the property, normally you would put 20% down. What I will tell you is in this market where the rates currently are, which is north of 7%, and it's been that way for, frankly, 2 years. And I got news for you. I don't think it's going down much. Maybe we'd be lucky if it goes down 1%, guys, unless the federal government absolutely slashes everything and we get a balanced budget. I don't see it happening personally. So you need to get used to 7%. And you can still make money doing that, by the way. So assuming the rates are 7%, it's better to put 25 to 30% down to cash flow. Okay, but I'm going to give you guys a real world example. And I was talking to a client about this earlier. So when you get a mortgage, you have principal and interest, which is, your principal paid down plus the interest on the loan. And let's say you're getting a mortgage for $500,000. Okay. A $500,000 mortgage over 30 years at about 7% is roughly $3,200 a month. So $3,200 a month is your expenses so far. The taxes on this property, you find out what the taxes are. Okay, so the taxes on this property are $10,000. 10,000 divided by 12, because you make monthly mortgage payments, so you're trying to figure out your monthly payment. 10,000 divided by 12 is $830. Okay, so we got $3,200, and now we got $830, right? And then the last one would be insurance. You need home insurance. The bank's going to want home insurance. On a two-family house, like rough ballpark might be like $1,800, okay? $1,800 divided by 12 is roughly about $150. So you take $3,200, $830, and $150. I'm rounding here, guys, so don't kill me. Your expenses are roughly about $4,200 a month for this property. Now, is something going to break in the property ever? Yeah. And I got news for you. You can't always blame the tenant. That doesn't work, guys. So what I teach my clients is, depending on the age of the property, depending on the condition, you want to budget maintenance anywhere from 2 to 8%. 8% is like a really old property. There's constant, like nothing's been maintained. 2% is like new construction, fully gutted, right? So if we assume on this, right, so on this property, our expenses are $4,200 a month. If we assume the rent is $5,000 and we calculate maintenance on the high side, I think 8%. 8% of 5,000 is $400 a month, right? So now you've got maintenance covered. So you got your mortgage payment plus maintenance. So now you're all in at $4,600. You collect $5,000 in rent. So you're profitable. The house cash flows, right? So that's a very easy way to do it. Now, obviously, if you want a property manager, you have to factor that in, right? And when factoring in a property manager, you also have to factor in your time. Do I want to be dealing with the tenants? Can I be driving 30, 45, 60 minutes to this property? And obviously, if you have a higher property manager, you're definitely going to need to put more down because you got to pay them to deal with the headaches that you don't want to deal with. So that's a quick example. Now, it's very difficult in this market to find a property that cash flows off the bat where you don't need to do anything. Like you just inherit the property, the tenants are living there, and it's cash flowing. They do exist, guys, but it's a challenge. Now, some ways around that are you don't put the minimum down. So I ran to one guy. He wanted to use an FHA loan, which means he wanted to put 3.5% down on a two-family. And he's like, yeah, it doesn't really cover my mortgage. I'm like, yeah, dude, because you're leveraged at 96.5%. Meaning like you only put 3.5% down. You put no money down, basically. Right? So it's not going to cash flow, not when the rates are 7. If the rates were 3, yeah, maybe it would have, but not when they're 7. So if you're going to get a mortgage, you're going to have to put more down. Now, if you underwrite this, and this is for any property you look at, it could be in Bloomfield, Jersey City, it could be, in Belmar, wherever it is. And if you underwrite it and you're cash flow negative on day one, that could be okay for a couple of reasons. Number one, you're like, you know what, Pete, I just care about appreciation. If I'm cash flow negative, a couple $100, I could live with that because each year, in theory, the rents are going to get raised because, why, guys? Because of inflation, because property taxes go up, insurance goes up, so you constantly need to raise the rent. You cannot keep the rent the same. Maybe a 2-year lease is fine, but you can't keep the rent the same for years and years and years. You'll get crushed. Okay, so if you're cash flow negative, but you care about appreciation, that's okay. And I have news for you. If you're buying for appreciation, a lot of those markets don't really cash flow. That's why people just, care about the appreciation in those markets. Another reason why it might be okay if you're cash flow negative, let's say you buy the property and the tenants are month to month. What's popular now is people will just say, you know what, I don't want to renew the lease, or maybe the tenant's behind on rent, the tenant has to get evicted, or another one is like someone's buying a two-family because they want to live in one unit. That's perfectly, legal, and you're perfectly, capable of doing that and allowed to do that. So, if it's cash flow negative when you buy it, that's fine, because what people will do is they'll clean up the house, they'll get it renovated, and then they'll rent it out at market rent. So let's go back to the example where I said, your monthly payment is $4,200 a month. 'Cause what's funny is I'll see this on the market, right? And I'll do the math for one of my clients. And like a lot of my clients, like you guys listening now, like you could do the math, right? So you're doing the math and it's like $4,200 a month. Like, Pete, what's the rent? I'm like, oh, the rent's $3,600, right? And so I go to the realtor. I'm like, well, so my client's supposed to buy this and lose $600 a month? Well, you could do, I got another call, Pete, I'll call you back. So they, I don't really think they understand that, because a lot of realtors don't sell multifamily. They sell a white picket fence in suburbia. They don't understand that if you're dealing with real estate investors, it's very transactional. There's very little emotion involved. Like, you're investing in real estate because you want to make money, So, but anyway, what people will do is they'll put up a house for sale at a very high price. The rents don't cover the mortgage. So as an investor, you have to get the tenants out in order to make money. And that's why what I'm seeing now a lot is the seller will have to deliver the property vacant or deliver a unit vacant. And sometimes the two parties won't agree on that, and the buyer has to kind of assume the risk on that. Now, if you buy a property that's under rented, that's not the end of the world, because depending on where, like, you could always renegotiate rents. I mean, or if the person's obviously, like, if it's problematic and there were, people are overcrowding, or there's like some health issues being caused, if there's a hoarder, then you could evict. Or you can write a check and say, listen, I'll cover your moving expenses, I'll cover your security deposit, blah, 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 blah. I need you out. I need to renovate this property. So at the end of the day, if the cash flow is negative when you're evaluating a property, don't say, oh, this is a no. That doesn't mean it's a no. Because if you fix it up and you get the rents higher, in 6 months to a year, all of a sudden it's nicely cash flow positive. Okay. So, and that's why, like, when you're evaluating deals, it's important to know, well, how long are the leases? Are they month to month? Or, do they have 6 months left, 9 months left? Because if a tenant has a lease in place, then you can't just kick them out. That like, they're humans, guys. They're not little pawns on a chessboard, right? So, then you have to follow the terms of the lease. So, and that's for if you have a mortgage, right? Now, if you have cash and you're paying cash, then it's a little bit different, right? Because you don't have a mortgage. So let's use this same example. The house is $650,000. You're going to pay cash, right? So your only expenses are that $10,000 property tax I talked about, the $1,800 a month insurance, right? So let's round it up and let's call that $12,000 your expenses. Another $400 a month in maintenance you're going to budget for. Okay, 400 times 12 is 4,800. 4,800 times 12, it's like 17,000 in expenses, right? So your expenses are 17K, and your rent is 5,000 a month, is 60,000. Okay, so your net operating income is 43,000. Let's call it. Did I do that right? Yes. 43,000 on a $650,000 property. That's a pretty decent return on investment, right? Let me see here, actually. 650 divided by 43. 43 divided by 650. Yeah, that's like a cap rate of 6.6%. That's pretty good for cash flow. So cap rate is what you're gonna pay if you. That's your return if you pay cash, basically, the cap rate. Okay. So I do see a lot of cash investors in this market, and it's a lot of people like, what's weird is I see cash investors under 500, and then I see cash investors like north of $1 million. For whatever reason, I don't see many between 500 and $1 million. But if you're going to pay cash, right, it's the same calculation. What's my taxes? What's my insurance? What's my maintenance cost? If you're going to have property management, what's my property management cost going to be? And then you at least have an idea going in of what the return will be, or if it cash flows. So those are two ways to calculate, guys, how the buy and hold works. Now, the third point I do want to make is you also have to underwrite, what will this property look like when it's stabilized, when it's fixed up, and when the dust settles, so to speak, right? So if you go back to these same examples, we have this $4,200 a month expense, and let's say the rents are only $3,000, right? You'd be stupid to buy that property, or would you? Because maybe you get the property delivered vacant, You put $100,000 in to fix it up, and now the rents are $6,000. Now you're making money. So it's very important to when you're evaluating the property to see what, at least for cash flow, when you're evaluating the property, to see what the potential rents can be as well. And that's why it's important to ask questions when you're at a showing. How long has the tenant lived there? Have they lived there 2 years, or have they lived there 22 years? 22 years, that's a long time. That's a little harder to get somebody out. And then to research, like what are the potential rents of this place? What are the potential rents of a 1-bedroom, a 2-bedroom, a 3-bedroom in this area? If I fix it up, what would the potential rents be? And I'll tell you guys, when you do fix up a property, the rents if you fix up a property, the rents are always going to be higher than if you don't. That's the best way I could put it. Because they're going to be more attractive. You'll get better tenants, and in most cases, you'll get better rent. Now, I will say there are outside influences that you can't control, right? Like whether it's government policy, if population is declining, job growth, some of the things I touched on with appreciation. But if you fix it up, I've yet to see that formula not work, where you get the rents higher and you're going to make more money. So anyway, guys, I hope this was helpful. I don't want to ramble on here too much. But yeah, this is the best way to calculate if a buy and hold rental works. So if you guys have any questions about this, feel free to DM me on Instagram, Pete Does Real Estate, or you could drop a comment. I'm happy to answer that as well. And let's go buy some real estate, guys. Let's go make some money, and let's build wealth for yourself.
Thanks for listening to the New Jersey Real Estate Investor Podcast. Make sure to subscribe so you don't miss the next episode. Until next time.